Hi, my name is Gabriel from Kodari Securities, and in this presentation, we will go over why people invest in shares, going over the benefits of investing into shares, and how an understanding of why people invest in shares will better inform overall decision making.
As always, all information given in this presentation is general in nature and does not take into account your personal needs or objectives. For further information, please visit our website www.kosec.com.au. So, we will outline why people invest in shares, the benefits of investing in shares, as well as the benefits of shares compared to other financial products. People may invest in shares in order to seek capital gains. This essentially means that investors want to purchase shares so they may sell them at a higher price than that which they bought it at. This is one of the most common reasons for share investing. We have covered the means by which to calculate capital gain in a previous video. However, some people may choose to invest in shares for the passive income which is provided by them in the form of dividend payments, which is provided to shareholders at the discretion of the company who has issued the shares. As mentioned in a previous video, dividend payments are subject to the decision-making processes of a company who may elect to or not to pay shares, with the value of dividends potentially fluctuating from year to year. This is heavily subject to the circumstances affecting the company, with most well-established companies paying a dividend of some description. Dividend payments provide owners of shares with passive income, as the company in which the shares are held pays dividends to holders. Dividends provide share owners with a portion of the company's earnings paid at a per-share rate. So naturally, the more shares you hold, the higher dividend payment you will receive. Dividend payments are subject to the performance of the company and the economic conditions. If a company is not performing well and the economic conditions are slightly contracted, a company may elect to pay a lower dividend or potentially no dividend at all. Payments from dividends count as taxable income, and as such, a shareholder is required to pay tax on dividend payment from companies. So to show a quick example, imagine if you held 5,000 shares of a company and they pay a dividend of 50 cents per share. This would provide you with a $2,500 check, which you receive for holding the company's shares. Aside from dividend payments, there are many other benefits to purchasing and holding shares. This can include shareholder voting rights, which allows the owner of the stock to vote at company meetings and help determine company direction. The more shares an investor owns, the more powerful their vote is, and consequently their influence on the company. This does not mean that a majority shareholder can simply unilaterally liquidate the board and leadership of a company, but it does provide them with significant leverage. Indeed, if an investor holds majority shares in a company, they are able to indirectly influence the direction of the company by voting in board of directors. This allows the shareholder to put in place board members who will make decisions that are in line with the goals of the majority shareholder. This is important as the board of directors make appointments regarding key leadership roles, such as that of the chief executive officer. This is one of the several benefits of share ownership. However, for most investors, this is not something that interests them or is feasible due to the strong capital costs associated with acquiring majority shares in a company. As such, for the vast majority of investors, entitlement to the company's profits as well as capital gain from an increase in the share price sustains the financial goals of an investor. Oftentimes, investors will choose to purchase shares because they offer higher returns than other financial products that are more low risk, such as bonds and real estate. Bonds are low risk and have lower returns as a result. A bond essentially operates as an item which provides the holder to interest on the bond, as well as a repayment of the principal. This makes the bondholder a creditor. The main benefit of this is that the bondholder, as a creditor, receives the first rights to the company's assets if the business declares bankruptcy. Owners of shares do not receive first rights and may actually get nothing in the event of a bankruptcy. This adds to the risk of shareholding. However, shares provide access to stronger capital gains than bonds, which makes them a very attractive proposition for investors. Indeed, due to the guarantees of a bond, the returns attained from them are inherently less than from the purchasing, selling, and holding of shares. On the other hand, investors may choose to place capital into real estate. This has become an asset class that has gained popularity over the past half century as a means by which to realize capital gains. Generally speaking, investing into real estate is a capital-intensive proposition and requires substantial maintenance and oversight to better facilitate a gain. There are many ways to achieve this. This could be through purchasing, renovating, and selling a property for a profit, purchasing and holding onto a property for a certain period of time with the assumption that it will increase in value, or gaining passive income through rental payments by leasing the property to tenants. These are all intensive and require large amounts of personal oversight to ensure the ample maintenance of the property. This can include insurance, maintenance costs, as well as taxes. In addition to this, many real estate investors will employ a property manager to oversee real estate on their behalf. This incurs additional costs. In addition to this, the stock market generally outperforms real estate, allowing an investor to realize capital gains significantly faster and with less initial capital required. If an investor has a heavy risk appetite, they may choose to invest in higher return and higher risk financial products such as derivatives. Derivatives essentially allow investors to bet on the movement of an equity or commodity. The investor does not own the underlying equity or commodity, but places an option on where the price will move. This is a high risk investment and can result in substantial capital loss if an investor is not well versed on the nature of the products. Shares operate as lower risk financial products that come with benefits of ownership that have previously been established. People invest in shares because shares are one of the best capital investment tools to grow wealth. In addition to this, they provide owners with benefits such as dividend payments as well as shareholder voting. This is an attractive proposition to investors as it appeals to a wide variety of financial goals. This differs critically from other financial products such as real estate, bonds, derivatives, which vary in risk. Initial capital required is quite high, and the returns are not quite the same.
So, in this presentation, we have gone over why people invest in shares, how shares differ from other financial products, and why they can be attractive propositions. I hope you have found this informative. This video has been brought to you by KOSEC, Kodari Securities. Thank you and have a nice day.